Hello and welcome to another chapter on US taxation. So today we are going to talk on the last credit, which is the foreign tax credit. With this, we are going to complete the entire series of the tax credit that is available to an individual for which the credit can be taken, and it's a dollar to dollar reduction in the tax liability. So these provisions are designed to balance the global income taxes. So basically, when we talk about the foreign tax credit, so foreign tax credit is typically a benefit given to an individual wherein he is earning some income from outside the US, and then he can get the benefit by getting the credit for the taxes that has been paid on the foreign income. How that calculation done, how it is being calculated, what are some of the eligibility criteria, exclusions, inclusions. We'll all discuss that in the upcoming slides. So let's start the discussion by looking at the agenda. Okay, so the key agenda item that we're going to cover today is introduction to the foreign tax credit, uh, eligibility criteria. We'll talk about the concept of the foreign source income. We'll also talk about the FTC limitation rule, and we'll understand the concept of carryback and carry forward rules in the FTC. We'll also understand the concept of foreign earned income exclusion and calculation of the FTC. We'll have a slide to understand the concept of planning and optimizing strategy, and then a key takeaways slide. So let's start the discussion then. Okay, let's understand the concept of the foreign tax credit. So what is the foreign tax credit? So foreign tax credit allows a taxpayer to claim the credit for the taxes paid in the foreign country. So which means that it directly reduces the US tax liability, which is dollar to dollar. And the purpose of FTC is to avoid the double taxation on the foreign income and promote the fair taxation for the global income. So typically a US individual who earned the income from the other country and taxes has been deducted in the another country, then those taxes can be claimed as a form of foreign tax credit. So US taxes the worldwide income, and without FTC, some income tax in foreign countries and the United States, and FTC's concept which ensure the relief from the double taxation. If foreign income concept is that if foreign income is equal to 10,000 and foreign tax paid is 2,000, then credit allowed is 2,000 subject to the limits which we'll discuss in the upcoming slide. And individuals can claim the FTC if they have the foreign income and taxes paid on the foreign government, and applies to the employees working abroad, investor earning foreign income, and business with the global operations. So key conditions like foreign taxes must be legally owned, paid or accrued based on the income and the taxes there. And the foreign tax credit is essential in the globalized economy where individuals and business are often earn income across the borders. It ensures the fairness by preventing the double taxation and plays a critical role in the international tax planning. So move to the next slide. Now we'll understand the eligibility criteria for the FTC. Uh, to claim the foreign tax credit, taxpayer must meet certain specific conditions so that the eligibility is there. And what are those eligibility? First of all is foreign taxes paid or accrued. Tax must be paid or accrued in the foreign country or the US possession and cannot be claimed FTC without the actual tax liability abroad. Must be an income tax or tax in lieu of the income tax. So example of foreign income tax and withholding income tax, but does not include any sale tax, VAT, GST or the property tax. Tax must be legally owned, not voluntary or refundable. Income must be classified as the foreign source income. Example, salary earned abroad, foreign dividend or the interest. So basically both the active income as well as the passive income are included as a part of the income which can be claimed as the foreign income. Inclusion in the US tax return, income must be reported in the US taxable income. And if income is excluded, then definitely under foreign earned income exclusion. So we'll discuss about that in the upcoming slides as well. So if somebody is claiming the FEIE, which is the foreign earned income exclusion, that the credit is not allowed. So either of those can be taken as a benefit, which is a foreign tax credit or foreign earned income exclusion. So taxpayer eligibility is US citizen, resident alien, certain non-resident limited cases, and taxpayer must choose the FTC or deduction from the foreign taxes but cannot claim both the same taxes. Documentation required is proof of the foreign income and the taxes paid, and includes the tax statement as well. And additional conditions is tax must be based on the net income, which is being computed as per the US tax laws, and must not violate the IRS rules to only double benefit. So which means that the typically eligibility criteria is that the person who is earning the foreign income must disclose that income, and then he should have the proper documentation. And the exclusion is if the income is under the concept of foreign earned income exclusion, then it will not be available for the FTC credit. So these are the eligibility criteria to claim the FTC credit. So we'll move to the next slide. Okay, so it is very, very important to understand the concept of foreign source income. So while we know that the income which is earned in the foreign is being subject to the taxes in the foreign, but let's understand the concept of the foreign earned income in context to the FTC and FEIE. So foreign source income is refers to the income earned outside the United States. So it is key requirement for claiming the foreign tax credit. Applies only on the foreign source income. And why it matters? Because eligibility for FTC and the amount allowable credit is only claim if somebody is paying the taxes in the foreign income in the foreign country. Incorrect classification means wrong FTC calculation of the disallowances. And what are some of the general rules which needs to be followed? So typically, the classification has been done on the 5 broader heads, which includes the foreign earned income, foreign investment income, rental income, and the business income and the capital gain. So foreign earned income is like salary or the wages earned outside the US, basis the place of the work. Foreign investment income is the dividend from the foreign company, interest from the foreign bank based on the location of the payer. Rental income, income from the property located outside the US. Business income is the income from the business operation conducted abroad, and the capital gain is the based on the location of the asset and residency of the individual. So these are the conditions basis which the foreign income will be included in the total income of the individual or the business, and then the FTC would be applied. So salary and wages is the place where the service is performed. Interest is the residence of the payer. Dividend is the place of the incorporation of the company. Rent is the location of the property, and the business income is the place of the business activity. Income must be properly segregated with the US and the foreign source, and important for the FTC calculation, because if it is not being properly allocated, then it will lead to the incorrect calculation of the FTC, which will be later disallowed. So foreign source income is the starting point of the FTC. The IRS uses the specific sources rules to determine where the income belongs. Miscalculation can lead to the incorrect credit, and so understanding these rule is essential so that there should be no disallowance when FTC credit is being claimed by an SSC. So we'll move to the next slide. Okay, so let's understand the concept of FTC limitation rule. So FTC limitation rule restrict the amount of the foreign tax credit that can be claimed. So what does this mean then? So it means that FTC cannot exceed the US tax attributable to the foreign income tax. So there is a formula that will be applied to do the correct calculation of the FTC. So FTC limitation formula is FTC limit, which is like foreign source income divided by the total income multiplied by the total tax liability. So which means that foreign source income will be included in the global income for the US, and then the tax liability calculated on the global income, and then this limitation formula is used, which is like foreign source income divided by total taxable income into the US tax liability, which will give the limit. So foreign source income is the income earned outside US, and total taxable is in global income, which includes the US plus foreign income. Step-by-step calculation, determine the total taxable income, and then identify the foreign source income, compute the US tax liability. So apply the formula to find the maximum ETC allowed. Compare with the actual foreign tax. For example, total income is 1 lakh, foreign income is 40,000, and US tax liability on the global income is 20,000. And the foreign tax paid is 10,000. So first we have to find the limit. So what we'll do, the foreign income divided by the total income, which is 40,000 divided by 1 lakh, into the US taxes paid on the global income is 20,000. The maximum limit is 8,000, and then it will be compared with the foreign taxes paid. So foreign taxes paid is 10,000. Credit is available to the extent of 8,000. So allowed is only 8,000, which is minimum of 2. Whatever excess has been there, which is like to the extent of 2,000, and it can be carried back for 1 year, or it can be carried forward for the next 10 years. And this FTC limitation rule ensures the fairness by allowing the credit only to the US taxation income, US tax foreign income, even if the higher foreign tax is paid. Excess cannot be immediately used, and midweek rule and the carry back or carry forward rule is applied. What is this carry back and carry forward rule? We'll discuss in the upcoming slides. So let's move to the next slide. Okay, so what is the concept of carry back and carry forward rules? We'll discuss this here. So sometimes the foreign tax credit paid excess of the FTC limitation, the excess which is there can be carried back to 1 year or carry forward to next 10 year. Why carry forward excess, carry over excess? Because FTC limitation may restrict the credit in the current year. Ensure that taxpayer can utilize the credit in the other years, provide the flexibility and the fairness. Carryback rule is what? Conditions that must have the foreign source income in the prior year and unused FTC capacity. Benefit immediate tax refund opportunity. So, which means that if somebody has excess credit in a particular year and that excess credit is can be carried back, and then definitely this gives an opportunity to generate the refund basis the carried back rule. Carried forward rule is if not used in the carried back, excess FTC can be carried forward up to the next 10 years. And there are certain rules to it because if FTC will be credit has to be satisfied with the carried back, then it has to have the foreign income in that carried back year as well. Uh, Order of utilization is the current year, carry back for the previous year, and then carry forward for future year. Step-by-step application is calculate the FTC for the current year, identify the excess credit, apply carry back to the prior year. Remaining balance is carry forward, use in the future year when limitation allows. So, for example, there is a credit of FTC limit of 8,000, foreign tax paid is 12,000, excess is 4,000. Carry back applied to prior year if unused capacity exists. This is very, very important. There has to be capacity which will then be applied to this foreign tax credit. If there is foreign tax credit available, then definitely it can be adjusted in that particular year, which for which the credit is there, and the remaining balance will be carried forward up to the 10 years. So we'll move to the next slide. Okay, now we'll talk about the foreign earned income exclusion. So what does this mean? So this is very, very important concept in context to the foreign income. So the foreign earned income exclusion allows the US taxpayer to exclude the foreign income earned from the US taxation. So which means that this is not forming part of the taxable income itself. So maximum exclusion is 1,20,000 per year, applies to per taxpayer, and type of the incomes are salary and the wages earned abroad or the employment income. What is not included is the passive income, which is dividend, interest, and the capital gain. So only earned or active income qualifies for this eligibility. Have a foreign income earned, have a tax home in the foreign country, meet one of the following conditions. So these are the conditions which are there to qualify to claim a particular income as the foreign earned income exclusion. So which is like physical presence test, stay outside India for 330 days in 12-month period, and be a resident of the foreign country for the full tax year. There's some additional benefit or housing exclusion which can be exclude certain housing expenses subject to the limits. And why this is important, because either of them can be claimed, foreign earned income exclusion or FTC, both cannot be claimed together. So typically in the foreign income, first apply the FEIE, and on the remaining income you can apply the FTC if that income includes the passive income as well. So scenario is like, for example, we have a foreign salary of 1 lakh, FEIE limit is 1,20,000, so entire income is excluded, and hence there is no taxable income in the US. So prefer FEIE when foreign taxes rates are low and want to reduce the tax liability directly. So foreign earned income exclusion particularly used for the individual working abroad in the low tax countries. It reduces the taxable income directly, but careful planning is needed because it limits the use of the foreign tax credit. A physical presence test, stay outside India, US 330 days in 12-month period is very, very important. So we'll move to the next slide. Okay, now we'll understand the calculation of the FTC. So foreign tax credit is calculated through structured process to ensure that it is calculated accurately. And what is the step-by-step method? So we have to first identify the foreign source income, compute the total taxable income, including that foreign taxable income, and then calculate the US tax liability on the entire global income. And then what we have to do, we have to determine the foreign taxes paid. Then we have to apply the FTC formula, whereby foreign income divided by total income to US tax liability. And when we'll apply that limit, the final tax liability is calculated, wherein the US tax liability minus allowed FTC. So let's move to the next slide and look at the example and understand it with more detail. Okay, so scenario is that we have a taxpayer details. So US person is working abroad and total income is 1,50,000. The breakup is foreign income salary is 1 lakh, foreign dividends and foreign investment is 30,000 and 20,000 respectively. And then we have the income type salary on the which taxes has been paid in the foreign countries 20,000, on dividend 6,000, and on interest 4,000. So step one, we'll have to first understand the concept of FEIE, and we'll apply that FEIE, assuming that all the conditions has been applied to claim the FEIE benefit. So salary is 1 lakh, FEIE limit is 1,20,000. So entire 1 lakh is excluded from the taxable income. So then what we have is only passive income and there is no active income. So total income is 50,000. Then what we'll do, we'll apply the income tax on the 50,000. So FTC application is the basket wise. So FTC applies separately on the passive income, and foreign tax paid is 10,000, which is the sum of 6,000 plus 4,000. Assume the US tax on the passive income is 12,000. So then what we have the credit of 10,000 taxes paid as 10,000 and taxes on the US is 12,000. So our limit is lower of the two, so lower of foreign tax or whatever FTC limit which is there 12,000. So allowed is 10,000. So active income bracket, there is no FTC allowed. On the US taxation passive income 12,000, FTC allows 10,000. So final US tax payable is 2,000. This explains us the concept of how we have to use the FEIE and then calculate this separately the FTC on the foreign income which is earned in the form of dividend interest or the rental income, which is not the active income. Okay, now since we have understood the concept of FTC, it is always important to look at some of the strategy to maximize the benefit. What are some of the key areas that we need to look into so that we can maximize the benefit? So maximize the tax saving by avoid the credit wastage, improve the cash flow and tax efficiencies. Optimizing credit versus reduction. So we have to figure out which is more benefit, whether it is benefit for taking the deduction or taking the FTC benefit. Manage the income timing, shift the income between the years so that we can get the FTC limitation range. We are out of the FTC limitation range. Utilize the carry forward effectively. So carry back for the immediate benefit and carry forward for the future optimization. And then we can optimize the foreign versus domestic income tax income mix. For example, higher foreign income is equal to higher FTC limit. Strategies to align foreign income proportion with the foreign taxes paid. Uh, Avoid the double benefit issues and make sure that we have planned our uh, general income and the passive income, and then we need to take a decision whether we have to take the entire income as a tax free for general income, and on passive income we can utilize the FTC. So with this, we come to the end of this chapter. Let's quickly move to the key takeaways slide then. Okay, so what are some of the key takeaways of this chapter? So US taxes the global income, leading to the double taxation, and hence FTC and the foreign earned income exclusion are the benefit that is given to the person. FTC reduces the tax liability and FEIE reduces the taxable income itself. Income classification is critical. So active is the earned income and passive income is investment income. So FTC applies separately for the each category. This is a basket system. Uh, FEIE apply only to the earned active income and not to the passive income. Physical presence and bona fide residency tests are there to ensure that one can claim the benefit of FEIE. FTC limitation rule is there. FTC is limited to the US taxation on the foreign income, and excess credit is either carried back or carried forward. And carried back can again be done only if it is a foreign income is there, and then limit is available. So we'll move to the final thank you slide and see what all we have as a part of the next chapter. Okay, so now that we have covered the foreign tax credit and the foreign earned income exclusion, one key insights become very, very clear that taxation is not just about the rules, but about how these rules are applied in practice. And we have now explored multiple credits: child tax credit, earned tax credit, earned income credit, tax credit, education credit, and then finally the foreign tax credit today. So each of these impacts the final tax outcome, but only if they are properly reported and filed. Because no matter how well you understand the tax concept, the real value is realized only when they're actually reflected in the tax return. So this brings us to the next most important step in the journey, which is tax filing basics. So in the next chapter, we will move from the concept of the application and understand how tax returns are structured, filing statuses, form and the documentation, and how all these credits come together in the final filing processes. So now let's transition to the understanding the foundation of the tax filing, and everything that we have learned so far fits into the bigger picture. So thank you for watching this video. Stay tuned and wait for the next chapter that we're going to come up with. Thank you.